Hello and welcome to our discussion on financial statements. We continue our discussion on accounting for leases. In the previous session we saw that the acquisition of plant can happen by either through buying an asset or leasing an asset. And if you lease an asset, the lease can be an operating lease or finance lease depending on the amount of significance of the risk being transferred. If significant risk attached to the property transferred, then it will be a finance lease, and if not, then it will be treated as an operating lease. In this example, in this session, we'll take an example of a finance lease. That means we assume that this plant's risk attached to this plant has been transferred to the lessee. So finance lease, the conditions are the lease rent 50,000, lease period is 5 years, and since we are calling it a finance lease, the accounting standard says the finance lease shall recognize an asset on the balance sheet at the time of taking the lease, and those assets and the corresponding liabilities are shown at the fair value or the present value of the lease payment, whichever is lower. For the time being, we'll only use the present value of the lease payments. And to find the present value of the lease payment, the interest rate is taken as the discount rate. So, in this example, the discount rate is 6%. So, the value of the leased asset and the corresponding liability will be the present value of 50,000 for 5 years discounted at 6%, and that is equal to 210,000. So 210,000 we got by using the PV function of Excel. So the value of the asset and the corresponding liability on the balance sheet is 210,618. Now since this is the lease rent payable, the accounting standard says subsequent every year the lease rent shall be apportioned between the finance charge and the reduction in the principal component of the loan. So there is a need to classify the lease rent into interest and the principal. For that purpose, we create a lease statement. So the lease payable in the first year is at the time of the contract is 210,618, and the lease rent is 50,000. So the interest is calculated as the principal amount, and the balance is treated as the principal component of the lease rent. So this is the 50,000 minus interest, and this will go towards the reduction of the lease payable. So the lease payable opening next year is equal to the last year's lease payable minus the principal pay component of the lease rent is equal to the closing. So once again, the interest will be calculated on this. So the lease rent for the next year and the corresponding interest and the principal is calculated accordingly. So we can do that for all the 5 years, and we see that the total money paid in the form of lease rent is 250,000. 50,000 into 5, which is divided into interest and the corresponding component of the principal. So 250,000 includes 39,380 as a interest, and the balance goes towards the original cost of the asset. So the excess money paid over the original cost is treated as an asset. So in case of a finance lease, there is a need to classify the lease rent into interest and the principal. Now since this is an asset is created and a corresponding liability is created, and the liability has an interest, so the asset will also have a corresponding depreciation. So let us create the depreciation schedule. So depreciation will depend on the methods of depreciation. You can have any method. Here we are discussing straight line, reducing balance, and also principal component of the lease rent as the depreciation. Suppose we are using straight line method. So straight line method is apportioning the cost over the life, so by 5. So all these 5 years we have the depreciation same, and so that at the end of the life the entire cost has been recovered. So the depreciation rate, if it is an SLM, is 20%. So we got that as 20% over 5 years. By using a rule of thumb, we say that the depreciation under RBM will be more than this straight line method. So therefore we will use around 2.5 times. So we say it is 50%. So if it is 50%, the depreciation for these 5 years will be calculated on the opening balance, and the balance will goes on reducing, and the last year, assuming that the life will end at its 5th year, so the balancing amount has been treated as the depreciation. So the total depreciation in this year, the total depreciation over a period of time is same, but depreciation at a point of time is not same. Sometimes it is also possible to treat the principal component of the lease rent as the depreciation. So that means in this case we are treating the principal component of the lease rent as depreciation. So the total value recovered by the end of the life of the lease period and the life of the asset is 210,000. So we can see that the depreciation depends on the methods as per the relevant accounting standard. Now let us observe that interest and depreciation is an expense for the period. If interest and depreciation is the expense for the period, we can see that the depreciation and interest depends on, the total depends on the method of the depreciation that we have. So by using different methods of depreciation, the expenses will also be different. You can see that the expenses charged in the income statement overall may be same, but in a particular period the depreciation is responsible for the difference in the expenses. So all other things remaining constant, the high expense in the first year will lead to low profit in the first year, and this high expense is because of high depreciation, and high depreciation is because of the methods of depreciation. Interest is same in all the cases are same. So therefore, depending on the methods of depreciation, there is a possibility that the profits of the company can change. If we would have treated this as an operating lease, then the expense would be shown as 50,000. So now the question comes that under what situation the operating lease, the expense in the income statement, will be same as the expense under the finance lease? We can observe, we can see this. So finance lease and operating lease will have the same effect on the income statement if the depreciation used is equal to the principal component of the lease rent. But if the depreciation is not principal component but straight line or reducing balance, then the expense in the income statement will not be same as 50,000. So the profit under operating lease will be different from the profit under finance lease. So therefore, there is an important question, the whether to buy or lease, and within leasing, whether to show that as an operating lease or a finance lease is a very, very important managerial decision, because the expense which consists of interest and depreciation changes because of the methods of depreciation. So there is a managerial issue there, buying versus leasing, and in the leasing is an operating lease versus finance lease. So whenever we pick up a financial statements for analysis, there is a need to examine how the company is treating the lease, and within the lease which method of depreciation is being used for finance lease. Thank you very much.